The Fed has now enacted its sixth rate cut of the current cycle. While the decision was telegraphed by economic data, Powell's messaging stole the spotlight as additional labor reports signaled increasing softness in the job market. Good afternoon. As expected, the Federal Reserve adjusted the Fed funds rate last week, while recent economic data supported the decision to cut. The more notable takeaway came from Chair Powell's comments during the post-meeting press conference and how the Fed views the current economic backdrop. Markets initially reacted well on Wednesday, but some selling pressure emerged on Thursday and Friday following stronger than expected data. As a result, bonds ended the week relatively unchanged from the pre-announcement levels, with the 10-year Treasury sitting around 4.18%. For perspective, when rates dipped late this summer, the 10-year fell as low as 3.95%. We still have some ground to cover before reaching year-to-date lows again in mortgage rates, but momentum appears to be moving in the right direction. Let's dive into what took place last week. Here are your headlines. In the final meeting of the year, the Federal Reserve cut their benchmark Fed funds rate by 25 basis points to a target range of 3.5 to 3.75%, the third reduction of the year. The Fed funds rate, which is the rate for banks that use for overnight borrowing, doesn't directly set mortgage rates, but does influence borrowing costs across the economy. The move was unanimous. Governor Stephen Murin pushed for a bigger 50 basis point cut, while Kansas City's Jeffrey Schmid and Chicago's Austin Goolsbee wanted to hold rates steady, highlighting the Fed's challenge of managing elevated inflation alongside a softening job market. So what are the Fed takeaways? Powell emphasized a more patient, data-dependent approach, noting the Fed is, quote, well-positioned to wait and see how the economy evolves. While immediate cuts may pause, a rate hike is not the base case expectation, and future adjustments are still likely to lean lower. The policy statement struck a slightly more hawkish tone, signaling less urgency to cut as inflation trends improve. Powell also acknowledged an ongoing tariff-related inflation pressures and a softening labor market, both of which remain key variables. Overall, the Fed expects slow but steady growth, unemployment to rise modestly, and inflation to move closer to the 2% target in 2026. For next year, the median forecast points to at least one additional 25 basis point cut, but the outlook may skew as new members are voted in. Now, delayed data for September and October showed job openings coming in stronger than expected, rising from 7.23 million in August to 7.66 million in September and 7.67 million in October. However, the headline figure may be inflated as many remote positions are posted across multiple states. So what is the takeaway? Despite the recent uptick, job openings remain well below the 2022 peak of more than 12 million, and the underlying metrics point to continued cooling. The hiring rate of 3.2% is tied for the lowest level since 2011 outside of the pandemic. Layoffs have risen to their highest since January of 2022, and the quit rate of 1.8% is at its lowest since 2014, again excluding the pandemic, signaling weaker demand for workers and less confidence among employees who switch jobs. Now, in other labor news, initial jobless claims rose by 44,000 to 236,000, the highest level since September, following an unusually low reading during Thanksgiving week. Continuing claims, which lag initial claims by 1 week, fell sharply by 99,000 to 1.84 million. So what is the bigger picture? The large drop in continuing claims was likely driven by holiday-related distortions and expiring benefits. The reference week for continuing claims included Thanksgiving, when holiday travel can suppress filings. In addition, most states provide up to 26 weeks of benefits. Looking back that far, a spike in initial claims last May and early June means many recipients may now be reaching the end of eligibility. Together, data quirks and benefit expirations are likely to explain the sharp decline. This week is shaped up for a major one for the economic markets as we count down the final days of 2025. We kick things off with home builder confidence, followed by November's existing home sales report on Friday. The real focus, however, comes from a wave of delayed government data due to the shutdown, including key jobs reports and retail sales on Tuesday, followed by CPI inflation report on Thursday. With so much pent-up data hitting the market at once, volatility is likely. It's simply a question of whether the reaction is positive or negative. I'll be in touch with another update next week, but for now, have a great rest of your day.